Welcome to All the F Words,
a podcast where two writer friends, nearly 30 years apart, explore everything we give an F about. I'm Gabby Moskowitz.
And I'm Joanne Green. On each episode of All the F Words, we'll focus on a theme starting with the letter F. Things like fantasy, fashion, and philo-Semitism.
Doesn't that start with a PH?
Picky, picky, picky.
We'll share stories from our lives and our distinct generational perspectives and look to experts for insights and ideas.
Today, we're going to talk about finances, personal finances, with Dr. Mike Arnold, who spent years as a lecturer at UC Berkeley, a consultant in the banking industry, and now teaches adults, which I think is code for elderly people like myself, through the Fromm Institute and the Osher Lifelong Learning Institute in San Francisco, Marin, and Sonoma counties. Welcome, Mike.
Glad to be here.
As let's say creative types, neither Joanne nor I can claim any expertise in the area of finance. So we're hoping to learn a few things from Mike today.
Here's what I know, that some of the brightest minds go into finance, where they make obscene amounts of money, that most of the rest of us are clueless when it comes to the broader principles of finance, and that we are very easily influenced by what we hear and see in the media. Would you agree, Mike?
Absolutely. The media focuses on the winners and the losers.
Why do you think that is?
Because we're human beings, and that's far more interesting than somebody who's just making market returns over 20 years. It's far more interesting. It's the short-term volatility in the stock market and in the bond markets that generates constant press and constant misinformation. And also because more and more people are investing funds, partly because of the 401k system, and they think they can beat the market, and they can't.
So here's the thing. If the brightest minds are going into finance, Mike, does it take intelligence to make that kind of money? I mean, how does that work? If you say that nobody can really predict what's going to happen with the markets, then what are those incredibly bright minds doing?
Well, the incredibly bright minds are doing all kinds of things in finance. The finance industry is a large and growing industry, depending on which part of it they're operating in. But if you think about where the big money is made, for example, in hedge funds, they're investing huge amounts of money under the premise that somehow they can do a better job than just putting your money into a mutual fund. And some of them do and some of them don't. And the question is whether or not, if you go into one of those hedge funds, you picked a winner or you picked a loser.
So it's really gambling.
And it's also because the markets are so incredibly volatile in the short run. I mean, they move a lot. The price variance on stocks and the price variance on bonds, when it really starts to move, is significant. And it's the movement and the price changes that lead to winners and losers. So if you, quote unquote, bet right, you make a lot of money. And if you bet wrong, you lose a lot of money. And it's no different than a gambling casino.
That was my question. Is this any different really than gambling?
No, it is not. It's just, it has the image and the vision that it's different than a gambling casino. You can tell people, for example, you can make the analogy of going into a casino and you decide you're going to bet on red in roulette and you win. And you know, that person must know something. So you bet on red again and you hit a streak of where it's all red. And you say, well, they must really know something about this. But the reality is it's randomness associated with the roulette wheel. And it turns out in the short run, the way markets move up and down is about herd behavior of the vast number of investors out there and the heterogeneous nature of those investors. And they move markets up and down in the short run based on the latest piece of information. And you say, oh, that piece of info, I know what the Fed's going to do. And so therefore the market's going to go down. Well, the Fed makes an announcement the next day, and the very announcement that you expected, and the market goes up because they've interpreted it a different way. And the reality is, in the key elements of finance and personal finance, there's about 3 or 4 different guidelines to use. The number one guideline is to realize 99% of what you hear in the media is misinformation, and it's not how markets work. There is no beating the market in the short run. Some people claim sometimes they win for a while and then they lose. Look at what just happened to FTX. The reality is, over the long run, however, the market is way more predictable. It is, in mathematical terms, it's called a mean reverting process. The data demonstrates that it's mean reverting. Just because it's been mean reverting for the last 100 years doesn't mean it will be. But in general, why there have been books called, stocks for the long run is because over the long run, there exists in the real world what is called an equity premium. And what the equity premium is, if you invest in stocks over the long run, you will benefit significantly over investing in fixed income instruments like treasury bonds. It's in the data. And the question is, why does that occur? And economists have labeled it the equity premium puzzle. And the reason is it's called a puzzle is because they don't have any good models to explain why do equities return such a premium returns. On average, over a 30-year period, you're going to make something like an 8% on average return with a good deal of volatility in the short term. There's no question about it. And this is why they say buy into a diversified portfolio, hold it, don't do anything with it, and live with it for 30 years, and you will be very much better off. There's no question about it. And all the data shows it. But you got to do that. And that's what makes humans different. They don't do that. They buy and sell. The surveys that are out there on what the humans do, even when they buy diversified portfolios, they buy and sell them in the short run, thinking they can guess when the value of that diversified investment is going to go up and when it's going down. And they regularly underperform the market.
Yeah, I'm going to just jump in for a minute. So couple things. First of all, I would love to hear a little bit more about your background. Joanne talked about various places you've lectured, but I'd like to hear about how you got into finance, and I assume before you were teaching and lecturing, you were working in finance. I'd love to hear about that, and also I caught most of what you just said, but would love to. I wonder if we could break it down to basics a little bit. Let's say, first, let's start with if you could tell us about you, and then maybe we could talk a little bit about sort of what creating a diverse portfolio looks like for someone who is not an expert.
Well, there's about 3 questions there, and it'll probably take the rest of the session to get through the 3 questions. But here,
no, you do this is the Cliff Notes, Mike.
the Cliff Notes are when I got out of graduate school. I went to work for my father, who co-founded the firm, the Center for Continuing Study of the California Economy, which is still operating, even though he passed 12 years ago. And I went to work after that. After 1 year in Palo Alto, I went to work for the Department of Labor in Washington, D.C., thinking that possibly I was going to become an academic researcher, and decided after 2 years this was the last thing I wanted to do in my life, and was recruited into Citibank in New York City, which was looking for an economist. And I became chief economist of the U.S. Consumer Bank, which at the time was the largest consumer bank in the world. And that unit was built and constructed to measure and monitor and also hedge interest rate risk in the 1980s, during which period interest rates were extraordinarily volatile. I stayed there for a while, then went to work for Bank of America until we all got fired after the Nations Bank merger, then went to work for Deloitte, which is a big accounting firm, and you learn a lot about accounting, and then opened a consulting firm with my business partner, Bruce Campbell, in 2004, and we've been consulting in the financial industry ever since on the very issue that I learned on the road. One of the questions I was asked when I was interviewed at Citibank is, have you ever taken a course in finance? And the answer was no. And I never have.
So Gabby, when you ask a person in Mike's and my age group about what they did before or how they got, there's a very long answer because we've got decades to tell you
That's
about.
the problem.
Yeah.
You want the cliff notes. Those were the cliff notes.
Those were the cliff notes.
All
right, so
great.
let's break things down for the Luddites.
Okay.
Among
the big deal that happened, okay, one of the big things that occurred was there was a change in the accounting rules associated with defined benefit pension systems and how they had to be recorded on private companies' balance sheets. And simultaneously, that led to the creation of the 401k system, which shifted financial risk from those who were funding defined benefit financial systems to individual investors. And that's why there are those 401k systems. And it's that very reason that municipalities and states that still have defined benefit pension systems are suffering because they don't understand financial risk, and and taxpayers are going to have to cough up or lose services over the course of the next 10 years. The last stock market drop has also hammered defined benefit pension systems in this sector. So there's a lot more people out there investing, because before the investments were occurring by the managers of the pension systems, and now they're occurring by individuals. Sometimes the 401ks are within a corporation and they're managed by them. Typically, if you're in a 401k managed by a large corporation, it is almost by definition a diversified portfolio. There are lots of mutual funds out there that diversify. There are what are called EITFs, which are they're index-based managements, and you can get an S&P or Russell. There's all kinds of them that are out there. And that's how, in answer to your question, how does an individual diversify? That's how an individual diversifies, because unless they're extraordinarily wealthy, they wouldn't have the ability to buy enough stocks to meet various standards of diversification.
Okay. All right. So the takeaway is find out if you've got a 401k, find out who's in charge of the investing, and try to understand where the money's being distributed. Okay.
And most of them, they're being managed by well-known mutual funds or other well-known hedge managers, and typically over time they're going to come close to the overall stock market returns for one of the indices. I mean, that's how they're constructed. What you probably heard is buying mutual funds, however, is like throwing darts, because some mutual funds underperform and some mutual funds overperform. It makes you think that somebody knows something. And the reality is there's tons and tons of tests on this idea of winners and losers, and whether or not you can use past performance as an indicator of future performance. And if that were true, then everybody would go to the past performing mutual funds. And the answer
Mike, are there certain basic rules that one should follow when it comes to personal finance?
Absolutely. The first one has to do with age. When you're young, you might as well be invested in equities and put all your savings in equities, because you're going to learn the long term, and the long term is going to play out in those holdings. And just invest in a broad index and hold it, and don't think you can buy or sell in the short term, because you can't. But people do that, and unfortunately when they do that, they underperform the market, because humans get scared when the markets go down, as the market has come down this year. There's no question about it. And they sell, but they sell after the market's gone down. And then the market.
But what's counterintuitive about that is that you think when you're young, that's when you can afford to take risks. When you're older, you have to be more conservative.
It depends on what your overall plan is. There's two aspects to aging. First of all, your time horizon. gets a lot shorter when you get into your 60s. There's no question about it. But there may be a question about what you want to do, having to do with your own retirement or bequests to children or gifts to other well-meaning organizations, whatever you might want to do. And that typically leads to developing what's called a balanced portfolio. And the question becomes, okay, if I have X dollars of net worth, how should I invest it? And the answer is, as you get older, prudent investors typically are going to reduce the proportion of their net worth held in equities. The exact number at which you choose to do that, however, is very personal, based on all kinds of factors, including whether or not you have enough money for retirement, whether you need funds. One of the things you don't want to do is, if you're really relying on your stock market returns to fund your retirement, then you are subject to what happens to the market, in which case it could impact your ability to consume. And that's why they say, well, that's why you should invest in fixed income. At that point, more and more in fixed income. The other thing is the rules get more and more, the tax rules particularly, get more and more complicated as you get older. Way more complicated. Such as, one of the things investors do is they overinvest in deferred retirement systems. It's a well-known, invest in an IRA, invest in a 401k. Oh, it's all deferred. Wonderful. Oh, yeah, I don't have to pay any taxes. Yeah, that until you turn 72, and then you're required to, they're called RMDs, required minimum distribution, and that comes out as income. So the example is, you're a young person, you invested in Google and Facebook and Apple, and you made a fortune, and it's all in a 401k system, and you hit 72, and suddenly, rather than paying a much lower tax rate on a capital gains, you're paying a much higher tax rate because it's treated as income. So one needs to be careful regarding how they do that, and that's rarely talked about.
What about buying a house? It was always a solid investment approach if you could do it. And of course, fewer and fewer Americans can at this point in time. But if you can, is that still considered a good place to put your money?
Where did you get the idea that when you say fewer and fewer Americans can, are you just referring to because of the uptick in interest rates and making mortgages more expensive? Is that what you're referring to? Yeah.
I mean, I think one trend that we've seen a lot of is with the pandemic, a lot of people are moving out of cities and into houses and buying them, because that's usually how you get into a house. And the real estate market, cost of homes is so much higher than it was even 5 years ago.
It absolutely is. And that in part has to do with pre-fall of 2021, when interest rates started going up and increasing mortgage rates. It's because we had almost 10 years of very, very low interest rates. There's a huge leverage factor associated between interest rates and what your monthly mortgage payment is. And that provided a lot of stimulus to the purchases of homes that people desired. And that occurred also during the pandemic. And people desired to get out of cities. And one of the results of that was that the relative housing prices in suburbs went up relative to cities. There's no question about it. So the statement that fewer and fewer people are able to buy housing, if fewer and fewer people are able to buy housing, why are the housing prices going up? Now, with higher interest rates, the housing prices are coming down. And Joanne's question was, when is housing a good investment? And the answer is, well, it depends. It depends on how big a house you buy, whether you manage your money. It's a great way for savings, in part because of the mortgage tax, the tax deduction on mortgage interest rates. And it matters how you finance it. And in the United States, we have this fixed rate mortgage instrument that contains something that is extraordinarily beneficial to private homeowners, which is, it's called no prepayment penalty. And what that allows you to do, you can finance a house when interest rates are high. And if you believe, as I do, that we're going to go through a cycle here. Interest rates, we're going to probably go into a recession, and then the Fed's going to start cutting interest rates, and the bond market's going to cut interest rates, and the mortgage rates are going to start coming down again. That's a situation where you finance the house at 6%, and 2 years later, you refi at 3%. And a lot of us who've been through these, when I first bought a house in 1983, the rate was 10%. And every year, as interest rates came down from those higher levels because inflation was coming down, I refied, and I kept refining until the Great Recession, and got an interest rate below 3% and been living on it ever since.
I need to pause for just a moment for a commercial break, but I do want to say going into it that our first mortgage was 14%.
There you
Wow.
go.
You're listening to All the F Words. I'm Joanne Green with Gabby Moskowitz, and our guest today is Dr. Mike Arnold, who is an economist. And I don't want to spend more time on your CV, but it is certainly in our show notes. We know that the Fed periodically raises interest rates. Why do they do that? And what is supposed to happen as a result?
Okay, so virtually every macroeconomic model that's worth much in terms of guiding public policy is, believe it or not, Keynesian based. And what that means is there is a widespread view and empirical belief that interest rates influence what's called aggregate demand. Higher interest rates lower aggregate demand, lower interest rates increase aggregate demand via the financial channel. People borrow more. When interest rates are lower, they borrow more. They spend more. When interest rates are higher, they can't afford to borrow as much, and they spend less. So the Achilles heel of macroeconomic systems has been, is, and will continue to be inflation. How do you manage inflation? And the pandemic has made a major challenge to a 25-year record where all the advanced economies on the planet had managed successfully, lowered inflation rates across all the countries, and maintained it for almost 25 years. Then pandemic upset that. We have a breakout of inflation, partly because of Ukraine, partly because of supply constraints, partly because of overstimulus of the economy. Okay, so what does the Fed do in response to that? It raises interest rates to try to take some of the fire and the heat out of the system. And what does that mean? It is going to generate higher unemployment, because with higher unemployment, people will spend less. And because people will spend less, the inventories in the businesses will start increasing, and businesses will have an incentive to say, well, we got to get off the shelf. We have to. It's supply and demand. We have to lower our prices to deal with it. All the models say this. There isn't a model out there that's worth a dime that doesn't have that. The issue is, how far do interest rates have to go, and how much unemployment do they need to generate to pull the inflation out of this system now, and how long will it take? Nobody knows. The models aren't that good to be able to predict turning points and how long they last. Most economists who are paying attention to the economy believe there is going to be a recession probably sometime early next year, but they don't expect a major recession. And they're kind of predicting the inflation's already slowed down and it's going to drain out of the system. So there's a lot of speculation regarding how long that goes on for, but that's why they're doing it. And once they see the recession, they're going to start lowering interest rates.
Mike, I'm wondering if given that there is a recession potentially on the horizon, could you share some tips for, how people can shore up their finances, be prepared, decisions that you suggest or don't suggest making during a
Yeah.
recession?
Well, first of all, recessions are all about the short run. Okay, so therefore, your personal finances should be based on long-term strategic objectives, recognizing that occasionally the market's going to go way up more than you thought, and the market's going to go way down more than you thought, and interest rates are going to go up. There'll be recessions. And so you should always be managing things toward the longer term and forgetting just the vagaries in the markets that occur in the short run. I mean, you couldn't have predicted last October the market was going to tank as much as it did by March. Okay. Has the market bottomed? I get asked this question regularly. I don't have a clue, but I know this. Guessing on when the market's going to turn and guessing on when it's going to bottom is a fool's game. You cannot do it consistently. And the reason is, if you could do it consistently, you'd be very rich. And those that can do it consistently, theoretically, are very, very rich. But even all of the well-managed portfolios, like the ones at Stanford and Harvard and Buffett, they all work on longer-term strategies. They don't try to outbeat the market in the short run because there's too much volatility in the market and randomness tied to how individual investors are going to interpret a particular piece of news, such as, gee whiz, a week ago they thought the market had bottomed, but now people are getting locked up in China, and they think it's going to weaken the recovery. We haven't even gone through the recession yet, and that's the nature of short-term investing. And so, as a consequence, you shouldn't be investing based on recessions. What you should be investing in is over a longer-term strategy, and sticking to the longer-term strategy and doing that is hard enough, because when the market tanks like this, people get scared.
Mike, what are some of the biggest myths that you think people operate under in this country when it comes to personal finance?
Like in the micro sort of, is that what you mean? Like
one of them is financial advisors don't know anything. Another one, as indicated by quote unquote research, but of course the research doesn't have any data on financial advisors. They have data on mutual funds. The price data on mutual funds is you have a distribution of winners and losers in mutual funds, just like anything else.
So you advocate that people should have a financial advisor?
The real question is whether or not an individual can actually operate a long-term personal strategy without the emotional factors interplaying. And what are those emotional factors? Well, the market's tanked 20%. I think it's going to go down another 20%. I'm going to get out beforehand. Well, maybe it will and maybe it won't. The other one is the party phenomenon. The party phenomenon is you're at a dinner party and someone tells you they bought futures on lamb chops, and boy, they made a fortune on lamb chops, and by God, you should do it too. And you go, I hadn't even thought of that. That's a great idea. Well, are you controlled enough to realize it means nothing? It's no different than someone saying, well, I went into the casino and I bet on red and I walked out with a fortune.
So you're saying if you have a financial advisor, there's some objectivity there, or at least there's some hedge against these kind of temptations.
If you have a good financial advisor, and that's part of the challenge of all of this stuff is, there are good lawyers and there are bad lawyers. There are good doctors and there are bad doctors. There are good financial advisors and there are bad financial advisors. But those who use financial advisors, it helps them get through these kinds of periods where there's a good deal of market volatility and fear. And what you don't want to do is respond to those fears because you think you know something, but you don't really know something. And it takes a good deal of strategic thinking and understanding about finance regarding getting through the system. I mean, the biggest challenge we've had in the last 20 years was, of course, the Great Recession. I mean, the market tanked 50%. That is a huge decline in the market. And getting through that, well, just look at how long it took before the investors that had stayed in the market and not sold, their net worth returned to where it was. It wasn't that as far.
How long did that take?
Oh, I'd have to look depending on which mix, but over a year.
That's not much.
Yeah, but the market bottomed in March of 2009, and you couldn't have predicted in March of 2009 that it was going to turn and take off and lead to an unbelievable bull market that lasted till March of 2020. That's a 10-year one.
What should a consumer look for in a financial advisor? Like, let's say you're looking to hire one. What are some key things to keep an eye out for?
It's extraordinarily personal. So the first thing to do is, do you like and trust the financial advisor? And that's something that takes time. There's no question. It's very personal. I mean, you're sharing. I mean, over time, if you have a financial advisor and you end up having a long-term relationship with the financial, just think about that. So you get a financial advisor when you're 40, okay? And you're continuing to use that financial advisor when you're 70. That's a 30-year relationship. It would be a good idea to have personal like and respect for one another, because one of the things you find out about good financial advisors is they're advising people with different goals and objectives and different constraints: health, marriage, kids, grandkids, bequeaths, different levels of wealth. In terms of how you do this, it's an extraordinarily complicated thing. And mostly what you hear about, in the media is just noise. Well, financial advisors don't know it. I can't believe you're using a financial advisor. They don't know anything. What makes you think a financial advisor knows anything? And that's the problem. But the big part of the role of the financial advisor is to take away the fear factor and the guessing factor, to think that you can really beat the market in the short run, because you can't. And interest rates are the same way. I mean, as someone who's advised banks on interest rates, I assure you, there aren't many bankers that knew in the summer of 2008, they should take all the money in the bank and put it into a long treasury bond, because the payoff of that particular strategy, if they could have foreseen what was going to happen, was enormous. They could have ridden that they could have ridden that for 10 years. No one did it. Why? Well, because interest rates aren't predictable either.
This has all been very enlightening and great advice. An overview, to be sure. Mike is not a financial advisor, and that was very conscious in Gabby's and my choice to bring on someone who is an economist, not a financial advisor. But I certainly wouldn't make any decisions without one. I know how little I know. And today I learned I know even less than I thought I knew. Thanks so much for listening today. I want to also share that the book I wrote by accident, A Memoir of Letting Go, which is coming out in June 2023, is now available on pre-order anywhere. Your local independent bookseller, and if you're in the Bay Area, that could be Book Passage or Copperfields or any one of a number of others. Also, of course, things like Barnes & Noble and Amazon and all of those places. So if you're interested, you can pre-order now.
It's very good. I've read it.
Oh, my goodness. She endorsed it even. She wrote a blurb. You can follow us on social media. Gabby can give you the details.
We are on Twitter, as long as it still exists, Facebook, Instagram, and YouTube at allthefwordspod. And you can email us at allthefwordspod@gmail.com.
Have a great week.
Bye.
Thanks for inviting me.